secret 401k strategies that no one's told you about.
It's Brian Preston, the money guy.
Brian, I'm excited about this show because we talk about 401ks a lot. We talk about how powerful they can be and how fantastic they are as a financial account. But there are some little known secrets that the general public might not know about. And these secrets might be that little extra tool that you need in your financial tool belt. So we're going to unpack those on today's show.
Well, there's a reason that 401k content is so important. This is typically the single largest financial investment that people have. We also know that this one gets the most from both you as well as from your employer because Uncle Sam gives a lot of economic incentives to contribute to your employer 401k.
And most folks have even heard the term 401k. Perhaps you've worked at a job before and you've had one, or your parents have had one. So it's pretty common. It's so common that we do an annual 401k by age series, and they tend to be some of our more popular shows. So if you've not checked out our 401k by age to know where you are at your specific age or where you should be, go check that out.
We've also, we pull from research that tells you just on your journey to building financial independence, we know 80% of millionaires invested in their 401k.
And then here's what's really interesting. Those millionaires, on average, saved for about 27 years before hitting that million dollar status, which means they reached that by about age 49. So most folks who have been utilizing a 401k, who've been utilizing a retirement account, have been doing it for a while and become at least fairly familiar with it.
And then to put an exclamation point on this, I always think about in the beginning, you're giving your time for money. If you think about what your labor is, it's time for money, but you are trying, your goal is to build financial independence so then you can buy with all of your assets and your resources to spend your time how you want. We created a great little illustration on if you do not want to miss your employer match, because guess what? If you equate it to time, think about this. A 1% employer match is the equivalent of about a week per year sacrifice.
Yeah, so if you're going to walk away from about half a week of pay to get a 1% employer match.
So if you put away 1%, half a week pay, if you fast forward out to retirement, what does that mean for you? That's 1.3 years. Now, that's not what the typical match is for employers. Let's go on the high end. What if you work for a very generous employer? Like I think about Bo, we try to give all of our employees 6 to 8% of their compensation. So if they're also giving 4% of their pay, if we had 10% going into this retirement plan, you think about that, that's 5.2 weeks sacrifice, but by retirement, that could be worth 13.4 years.
Well, I think that's even, what's really interesting is if they're getting, we're putting in 6%, they're putting in 4%. That 4% is only 2 weeks of sacrifice on their end, and yet it results in 13 additional years of pay gain in retirement. Employer matching is so important. 401ks as investment accounts and investment vehicles are so important. Again, so important, not only have we done shows about average 401k by age, we've covered some of the basics in the past. We did a show talking about 401k problems where we kind of walk through what is a 401k and how does it operate and what are some of the things that you ought to know about that. And that's sort of like your basic entry-level episode to 401ks. But here at the Money Guy Show, we like to go beyond basic. We like to go beyond common sense. So in today's show, we're going to share some of those unique and secret strategies that might be available that you may not know about.
So, Bo, let's jump into these. Number one is roll in and roll out provisions. We've heard last year, 2021, was the year that more people resigned than I think any other time in history. It was the Great Resignation. We had 47.8 million workers quit their job in 2021. That also created a unique thing. There's a lot of money sitting out there, too, from all those company 401ks.
Yeah, if you look at it from people changing jobs in the United States presently, this is data from Capitalize, about 24 million forgotten 401ks exist out there. And forgotten 401ks mean it's a 401k that's left with a previous employer. Well, if you add up the total amount of assets contained inside those 24 million accounts, it's over $1.3 trillion of dollars that are sitting out there that likely are not being actively looked at, actively taken advantage of, and have basically been abandoned. If you want to have effective soldiers in your army of dollar bills, you cannot leave them left behind.
Now, look, leaving behind a 401k, that might not be the worst thing in the world, because maybe you worked for a great employer that has a great retirement plan. A lot of Fortune 500 companies, thinking about them, they have the Vanguards, the Fidelities, the Charles Schwabs, where they have lots of investment selections. They have low-cost investment selections, and there's lots of diversification options. That's probably okay if you left your plan behind, but
purpose.
That's not everybody what has happened here. There's a lot of plans that you'd probably do much better if you were proactive and knew if you either needed to move it to your new employer's plan, rolled it to an IRA, or you at least would have gone through the exercise and know leaving it is the right decision.
Yeah, one of the things we do when someone becomes a client of the firm, Abound Wealth, they'll come to us and we'll kind of look at all of their account structure. Well, it's not uncommon for us to see all of these old abandoned accounts, these 401ks and 403bs, and it's almost like a patchwork quilt of the life that they've lived up until this point. We can almost tell you their employment history for the last 2 decades just based on the accounts that they left behind. Oftentimes it makes sense to consolidate those and bring them in together into one plan, especially if you have a really good plan, like you said, with low cost options where you can roll those old 401ks into the new 401k.
One of the things I always like to say, if your current employer has a really good retirement plan, you might want to go bring those old plans into your new plan just to simplify your life.
Sure.
As you get older, you're going to find that you crave simplicity, and consolidating accounts is a great resource on that journey to simplification. And also, Bo, I want you to talk a little bit about, we talk about Roth conversion or backdoor Roth contributions for people who make too much money where you can't contribute to a Roth IRA because of those income limitations. This might be your gateway opportunity by rolling and making sure you are making use of these 401ks.
Yeah, a lot of times if you're trying to be if your income is above the level where you can do regular Roth contributions, you may want to do backdoor Roths. Well, one of the ways to make backdoor Roth contributions tax-free is to not have any outside IRA assets or old 401k assets. Maybe you had a 401k that you rolled into an IRA. If you have a really good current year plan and it allows roll-ins, which almost all plans do, you could conceivably roll your IRA rollover or your old SEP IRA or your old simple IRA into your 401k plan. So that way it opens up the ability for you to do tax-free backdoor Roth conversions every year.
So let's make sure, your homework when you're trying to close out this section is just make sure you're not leaving it behind any 401k assets or old employer plans that are not being optimized for your life. I mean, that's the biggest thing. Don't leave behind with this great resignation to where assets are just sitting stagnant, not getting re-diversified and working towards your ultimate financial goals.
Now, we talk a lot about rolling in. Another thing to keep in mind is that for most plans, you'll want to check your plan document to make sure this is true. Even if you roll assets in, you often have the ability to roll those assets out as well. So one of the problems with 401ks, if I'm currently working at a company, I can't move that to an IRA when I'm working there in most circumstances, unless part of my 401k balance is roll in. So say you needed to open up a backdoor strategy for some reason. So you roll a large IRA rollover into your 401k, and then the law changes or your circumstances change. Or for some reason, you need to then roll your 401k assets in an IRA, or you need to have access to an individual retirement account. You can actually roll out, even if you're still working at that employer, those roll in contributions back out. So it's not like a one-time irrevocable thing, so long as your plan provider plan document allows for that to be the case.
So that covered the roll in and roll out options, but I want to talk about some of the, what I call it, secret or special rules that people don't know about, how they can actually get access to their employer plans through these special withdrawal provisions.
Now, I feel like before we talk about this, Brian, we ought to put on there the appropriate disclaimer that retirement assets are supposed to be for retirement, right? Like you want your army of dollar bills working for you, so you don't want to take those soldiers out of the battle too soon. You don't want to pull them out. But we all know that life happens, and sometimes there are special circumstances that we may not be 59 and a half yet, or we may not have left employment yet, but we're in a tight spot, and we need to have some access to capital. There are special provisions that are allowed within certain 401k plans.
Yeah, now look, I think not to keep adding disclaimers, I don't love you actually pulling your
not
money
at all.
out early, especially for some of these special things. But I think it's important to at least know, just in case you get into a pickle of a situation, you know all options so you can plan accordingly. And the first group is hardship withdrawals. And these can be emergency reasons that you had to get access to your account. You know, the big ones that come to mind is medical expenses, permanent disability, prevention of eviction or foreclosure, burial expenses, and then this is one, and look, I don't love this because hopefully you know with being part of the Money Guy family and the Financial Mutant, we give you a lot of latitude on that house down payment where you only have to put down 3 to 5% on that first home purchase. The government lets you actually get access to your 401k plans through a first-time home purchase provision. And by the way, their definition of first-time home purchase only means that you haven't bought a house in the last 2 years.
Not necessarily your first home purchase ever.
But it is important to recognize you're going to pay income taxes on this. Pay attention to some of these rules because that could be very scary.
Absolutely. And then there are other, so that covers sort of the hardship, the unique things that the IRS chisels out. But there are other ways that you can get money out of your 401k. One is a separation of service. If you end up leaving employment, you have the ability to move the money out of your 401k. Now, we often see people really screw this up, right? We often see people leave a 401k, go to a new job, and they say, okay, great, I'm just going to cash it out. Not realizing that if you cash it out, you have to pay ordinary income taxes on that, as well as a 10% penalty if you're under 59 and a half, or if you did not leave employment after age 55. One thing that people don't realize is if you are employed with your current employer in the year that you turn 55, you can actually access those 401k dollars between 55 and 59 and a half. So that's a special withdrawal provision if you separate service after 55, but before 59 and a half.
I always think for anybody who considers themselves part of the FIRE movement, the financial independence, retire early, pay attention to these provisions because if you are a person that's leaving the workforce at 55, definitely before 60, this is going to be your friend. We've actually worked with this on several clients where we figured out how much money would they need between 55 to 60 years of age. Yep. And we left that money back at the old employer's plan so we could pull that money out, still paid income taxes on those withdrawals, but we were avoiding those penalties because this is a great provision to give you access for an early withdrawal, early retirement.
Now, we're obviously talking about 401ks a lot in this episode. It's worth noting, though, if you are someone who has access to a 457 plan, the age limit restrictions the age limit restrictions do not apply. So, if you do have access to a 457 and you end up leaving employment, you may want to measure 2, 3, 4 times before you immediately decide to roll that into another 401k or another 403b.
Well, and that makes complete sense. If you think about the way 457s are designed, this is going to be your teachers, this is going to be your police officers, it's going to be your firefighters, and a lot of these type of careers will have early retirements before 59 and a half. It's nice that the 457 structure allows you to have access, still pay income taxes on those withdrawals, but at least you won't pay those early withdrawal penalties that a lot of the other retirement plans do have.
Now, this next one, we don't often talk about this strategy because, frankly, you just don't see it in practice a ton. But you guys have been asking for us to address this, asking for us to mention it, and it is a unique provision inside of certain types of retirement accounts is you can do between age 55 and 59 and a half what are called substantially equal periodic payments. Yes, technically there is a way to get to your IRA assets before 59 and a half, but I would not say it's incredibly simple to do so.
Yeah, this is one of those things. I call it the great fire puzzle because, a lot of people, if you knew you were retiring at, say, 49 years of age or 50 years of age, you're like, how in the world I am retirement rich. I have 7 figures and all these employer provided plans, these IRAs. How do I get actual access to this? Good news, the government has actually created this rule, the substantial equal periodic payments rule, where you essentially can go calculate how much money do you need to have, are you pulling out every year? Then you can go work through the government's calculations and you can actually back into how much you should leave behind. And then what I like is if you did have a 7-figure account or a multi-7-figure account, if you calculated out that the number was going to be $600,000, you could go roll the 1.4 if it was a $2 million account somewhere else.
That's right.
That money is going to be allocated and invested for the long term. And then you could keep that $600,000 that you think you would need in this example for the next 7 to 8 years. You could keep that in this essentially substantial equal periodic payment structure, so you can annuitize it and it'd be penalty free.
But no, there are some things that can run afoul. Once you start one of these programs inside of an account, you may not be able to make additions or distributions from the account, and that includes rollovers. If you violate these, there's a chance you will owe penalties and interest. So it's just very important to make sure if you're going to implement one of these strategies that you know what you're doing, so you don't run afoul of the unique rules that surround these.
Yeah, I mean, they're going to, at a minimum, have a 5-year hold. You have to do this for at least 5 years or reach 59 and a half. So this is not the type of planning decision that you should take lightly.
So another provision that you may be able to use to access retirement assets is for qualified and education expenses. Again, we get this question all the time, Brian, is if I'm saving for college or if I've got to pay for my kids' college, is this a good way to do it? Should I think about utilizing my retirement assets to do that? And there are special provisions. What you're able to do and what you should do are two very different things, though.
Yeah, this is one I always, I understand some of the hardship withdrawals we went through with medical expenses and some of those other things. But qualified tuition and education, be very careful with this because this can undercut some of your abilities. There's much better ways to save for college between 529s and so forth.
All right, and the last kind of special withdrawal provision, and we've done shows on this in the past as well, are 401k loans. Now, you may think this sounds amazing because I have an opportunity. I can actually borrow money from myself. I can pay myself back. I can make the interest. This seems like the best idea in the world. Brian, are 401k loans an amazing idea for someone to utilize in their financial plan?
Well, it does. I mean, on paper, I always say the brochure looks outstanding on this because you feel like, hey, I have this big pot of assets. I can go borrow from it. I will pay myself back. I'm essentially playing the part of the bank here.
Yep.
But we're forgetting there's a huge component here called opportunity cost because a lot of these 401k plans that allow you to do these loans do not allow you to make new contributions while you have an outstanding loan.
Right.
They also will keep out, a lot of times they even the employer funding, the match, and those type of things is excluded while you're in this. It's a penalty in a lot of ways. And we created a case study to show you what this opportunity cost could be costing you if you didn't know all the things, the blind spots that are working in the background.
So let's assume you have two coworkers, Clark and Eddie, both age 35, and they've accumulated $100,000 in their respective 401k plans. Let's say that they each make $50,000 a year, and they decide to put 15% of their salary, which equals about $625 a month, and receive a 3% employer match. That's sort of the baseline. However, Clark decides he wants to take out a 401k loan of $35,000 at a 4% interest rate to build a pool for his family. He wants to go create memories. So after building the pool, Clark has $35,000 less invested in his 401k than Eddie. He has $65,000 invested. Eddie has $100,000 invested. For the next 5 years, Clark pays $600 and almost $45 per month until the loan is paid off because he has to pay it off inside of 5 years. Eddie, however, keeps contributing 15% and getting the match in his 401k. Clark, because he has an outstanding 401k loan that he's paying back, is unable to make new contributions, and he also forgoes the employer match because he has the 401k loan outstanding. Well, after paying off his 401k loan, Clark's balance is now nearly $145,000. So he has the $65,000 plus he paid back the loan plus interest plus earnings on the $65,000. Eddie, however, after 5 years, has nearly $60,000 more in his 401k. So Clark has $144,000 with a pool. Eddie has $204,000.
So on the cusp of this, just 5 years into it, we see how there's a $60,000 difference. You're probably thinking, yeah, but that's okay because we also now have the memories. We have this pool in the backyard. That sounds great. But remember, there's a reason I have this koozie that says this $1 beer cost me $88. It's because growth, compounding growth, the eighth wonder of the world, is exponential.
Yep.
And so that $60,000 difference is not done. Guess what? It could have been working in the background. Bo, what does this actually mean by the time that Clark and Eddie retire?
Yeah, so if after this 5-year period, they both start contributing 15% again, because they're both hyper savers, they want to be financial mutants, and they do that for 25 more years. By retirement, Clark would have about $1.77 million in his 401k. Eddie, however, would have a little over $2.2 million. In other words, you could say that Clark's $35,000 pool loan cost him nearly $450,000 in retirement from just 5 years of contributions and employer match. That is how costly that decision can be for taking soldiers out of your army of dollar bills.
We covered this in great detail. We had an Ask the Money Guy episode titled, Should You Take Out a 401k Loan? But really what we're talking about, if you look at the next slide, what this is really hitting on is I love giving this, the younger you start saving, a lot of people are shocked. If I was talking about how much you'd have to save per month to be a millionaire, you're surprised to find out for a 20-something or 20-year-old, it's $95 a month.
Yep.
But when you do the math on it, you go, wait a minute, $95 a month for a 20-year-old, by the time they retire at 65 is going to be worth $1 million. That's crazy, because if I do the math on that, they've only put in $51,000. So how does $51,000 turn into $1 million? It's because close to $950,000 of the $1 million is actually the growth, exponential growth. So imagine that $35,000 pool that when we did Clark and Eddie, because we all know Clark Griswold built the pool, but instead he got the jelly of the month or whatever it was. This is what I think a lot of people don't understand. In their mind, they compartmentalize, hey, I'm making a $35,000 decision. That's because it's not just pools. How many people leave an employer and then go and buy a new car instead of rolling the money to let it keep working, they go buy a car, they buy the swimming pool. I'm telling you, you don't know which dollars you're taking. You're taking those dollars that exponentially could be so much larger. And a lot of you are saying, well, okay, that's a 20-year-old. That makes sense as it's 45 years of growth. Guys, this applies also to the 30-something too, because look at the 30-year-old, still 89% of your account, if you were putting in $270 a month, that only totals for 35 years $113,000. That means the other $887,000, or 89% of the account, is coming directly from the growth of the account, not your contribution, but you got to give the money the time to work. Even for 40-year-olds, you're going to put in $780 a month, or $234,000 over that 25-year period, still $766,000, or 77% of your $1 million is going to come from your army of dollars compounding over the years. Do not take your army of dollars off the field while they're still in their most impactful period of time and getting that compounding growth opportunity.
I think that's the big takeaway is you want your soldiers working for you, so you don't want to take them out of the game. Yes, there are special withdrawal provisions that exist inside your 401k, but just because you can doesn't mean you should. All right, Brian, let's talk about another one that's kind of unique inside of 401k provisions or secrets that you may not know about. Now, we all know when we have a 401k, we often have a list of investment options, and normally plans have a couple of investment options. There was a study done by Fidelity that found the average plan offers about 15.4 investment options across the fund lineup. Now, some plans are better than others. Some have really low expense ratios of 0.37% or even lower. Some plans have really, really expensive investment options, all the way up to 1.5%. So not all plans are created equal. Well, every now and then, inside of certain 401ks, you may see a very unique option called a self-directed brokerage account, which essentially allows you to open up your investment options to the entire investment universe.
So this sounds like, to me, Bo, this could be a blessing or this could be a curse.
That's right.
So we kind of probably need to break down. I know you had, because we're going to talk about the two that we're most familiar with. We had Fidelity. They had a brokerage link.
And this is actually from the Fidelity website. If you're someone who has a Fidelity 401k, you log into Net Benefits, you go see it. This is how you know if you have this. Log in, click on investments, and if you see a brokerage link tab there, that's a huge indicator that you have access to a self-directed brokerage account inside your Fidelity 401k.
So that's Fidelity, but we also know Charles Schwab offers these. They call it a little different. Instead of brokerage link like Fidelity, they have what's called PCRA. What is that?
Personal Choice Retirement Account.
Okay, and you actually have that up on the screen as well. So if anybody has a Charles Schwab 401k, this is probably what your login screen would also look like if you had that as an option. But I wanted to kind of talk about those pros and cons because it is one of those things. I know when we get a brand new client, we always we want to know what options do they have in their 401k. And it's not uncommon, even though you said the typical plan has 15.4 options, it's not uncommon that it will be cash or some stable value. It's going to be basic equities like your large cap holdings, and it's going to be some internationals, and it's going to be some bonds. And that's about all I can think that is assured. Now, is there going to be small companies? Is there going to be mid-sized companies? Is it going to have, access to index funds? Are they going to have international by different versions? Are they going to have real estate? These are all the different things you could think about, but that's the part where it could get confusing or it could be a blessing to you, and we can kind of cover that a little bit more too.
Yeah, it allows you to add asset classes beyond the traditional asset class that are available. Maybe you are that person who has a 7-figure retirement account, and so when you think about your pizza pie, your asset allocation, you're not able to fill in all those different pieces based on the 15 options available inside of your plan. So it does allow you to create a more robust investment strategy. It also may be the determining factor of whether it makes sense to roll in old 401ks into your new 401k, or whether it makes sense to roll in like an IRA rollover into your 401k. That broker or that self-directed option may be the thing that says, you know what, I'm okay doing this because I'm not going to lose any investment access to the universe of investments that I've previously been using.
And then we've already kind of alluded to this, and I love the fact that you just covered the backdoor Roth, because that's a great planning opportunity. Don't leave those abandoned assets. This might allow you to bring it in, not really leave anything on the sidelines, because you get to do full asset allocation. Take advantage of just go beyond the basics of just stocks, bonds, and cash. Well, there are some pitfalls though. You can have too much of a good thing and know yourself well in the fact that if you're a person that has analysis paralysis, meaning that, because there's all kind of research out there, and there's a reason that they only give you 15 options in your 401k, because they've heard, like, if Fidelity gave you access to their hundreds of funds, they've actually found that people like don't know what to do, and they actually make poor decisions, and they actually lead to not even making decisions at all. That is a negative thing. So if you find that you're going to be a person that's got analysis paralysis, or let's talk about, Bo, another thing. What if you get distracted trying to chase the hot dot? There was a headline that came out just this week that we ought to draw attention to. It made headlines everywhere that Fidelity is now going to allow Bitcoin in their 401ks.
Yeah, and look, does that make sense for your situation? Does it not make sense for your situation? That's probably an entirely different show for us to do. But having that access inside of a self-directed option may allow you to go further out on the risk spectrum than you should. Perhaps it's Bitcoin that you're thinking about, or maybe you want to invest everything in individual stock, or maybe you want to start doing some sort of penny stock strategy or some sort of day trading. Just because you have access to those types of things doesn't mean they're going to be the solution, the strategy that allows you to actually build towards financial independence.
Well, the only word of caution, because I'm not going to throw complete shade at this, even though I do think it's interesting. Now, a lot of people, because Berkshire Hathaway was having their annual shareholder meeting this week, and Warren Buffett made huge headlines because he said that he wouldn't take all the Bitcoin in the world for $25 or something like that. I mean, he just... people howling in the aisles about it, because a lot of people who were throwing shade at Warren said, well, of course, he's over 90. He doesn't understand it. But it is one of those things where what I worry about is, and take Bitcoin off the table, we know that 401ks are the assets that people cross over into 7-figure status. And I think the reason that works so well is because, think about it, you have a incentivized version that the government gives you tax breaks on. You have you put money in, your employer puts money in. It's rewarding consistent behavior, because every time you get paid, you're putting money in. And this is the account that 29 years in the future from when you start this process that crosses into that millionaire status when you're in your late 40s. If all of a sudden we broke down those good behaviors as an automated wealth building process with the distractions of chasing the hot dot, whether it's individual stocks or whether it's Bitcoin. You might find that 29 years in the future doesn't lead to the same result as a consistent automated wealth building process.
And here's the truth of the matter. You know, we mentioned some of our favorites. We mentioned Fidelity's brokerage link. We mentioned Charles Schwab's personal choice retirement account. Not all self-directed accounts are great. Some of them have a lot of fees for trading, or they're at smaller custodians that don't have robust investment options. Some plans may give you more freedom and more options than others. So just know, just because you have access to a self-directed choice doesn't mean it's one that you should take advantage of. You need to do the research yourself to see if this is actually a viable tool inside your tool belt. It's not uncommon. We may even have clients that have a brokerage link option or that have a PCRA option, but we opt not to use it because it doesn't make sense for their unique financial plan. So you need to answer the question, does this better help me achieve my financial goals, or is it more of a distraction?
So, Bo, we have one more thing to cover. Every time we cover this, I can't help but think about Daniel and his awesome slide cover. We should have brought it up, but there's an apex predator out there hunting. And it's, because we talk about what do we love? We love Roth IRAs. They're one of the most powerful retirement savings vehicles out there because they grow tax-free. That's right. You don't get a tax deduction on your contribution. However, once you contribute that money, once you invest that money, whatever it grows to become is completely tax-free when you pull it out in the future. And that's why, once again, I bring it back to compounding growth. If you put $1 in something when you're 20, especially a Roth IRA, and then you pull it out at retirement and it's worth the $88, think about the fact that 87 of the $88 grew completely tax-free. That's really powerful stuff. But we know the catch with this is the government only lets us put $6,000 a year into Roth IRAs. Well, there is what's called a mega backdoor Roth IRA that could push that number way up, way beyond. I'm talking about a factor of 10 on what you can put into these mega Roth IRAs.
Yeah, what a lot of people don't realize is when you have a 401k, we're all familiar with pre-tax contributions. We put money in, we get a tax deduction. And then most of us are familiar with Roth contributions. We put money in, we don't get a tax deduction, but they grow tax-free. What you may not recognize is that some 401ks actually have a third investment option. And that contribution option is called an after-tax 401k contribution. It is different than doing a Roth contribution, where Roth and pre-tax are limited to $20,500 a year for those under 50. After-tax contributions don't have that same limit. You can actually contribute all the way up to the Section 415 limit of $61,000. So for folks who have high incomes and they have this type of strategy or this type of availability in their plan, they can do exactly what Brian is talking about, a mega backdoor Roth where they max out their salary deferral at $20,500. If they're high income, they're probably doing that pre-tax. And then their employer puts in some matching, some nominal number based on whatever their salary is. Well, then any difference that's left between that sum and $61,000, you can do an after-tax 401k contribution. Well, if all you do is the after-tax, you put the money in and the earnings grow tax deferred. Just like any other normal retirement account, when you go to pull it out, you would pay ordinary income taxes on the earnings and you'd pull out the after-tax contributions tax-free. However, if you are executing this mega backdoor Roth strategy, you can actually convert those after-tax 401k contributions to Roth dollars so that when they start growing, they actually grow tax-free as well. So when you go to pull all of those dollars out, they're completely tax-free. So we see a lot of folks who not only can they do the $6,000 Roth IRA backdoor, they can do up to oftentimes $30,000, $35,000 of mega backdoor Roth contributions via their 401k that has this after-tax 401k contribution option.
There are some things you need to think about here, first of all, and we have a nice little diagram. We'll go over a decision-making chart on it, but I also want to make everybody very aware. That's $61,000 that Bo put out there. That's very frothy when you think about that becoming tax-free Roth. But you always have to be careful. You don't want to squeeze that free money out from your employer, because if you have an employer, especially, it's one thing to know what their matching formula is, but if you have an employer that does a variable profit sharing contribution every year, depending upon, you need to be very careful, because especially if there's a lot of variance in what your employer puts in, and if they're very generous, you don't want to, make the decision that you're going to load up that after tax to the point that you squeeze out. Because guess what? If you reach $61,000 and then some of that your employer tries to give more money above $61,000, but because you've already pre-funded the after tax, they just get to keep their money. It just doesn't go into your account. So that's why it's definitely a measure twice, cut once. But here's the other part of this. This is complicated. There is an entire group of questions you have to answer to even know if this strategy works for you.
So we're going to walk through sort of a flow chart you can think about, but this is a prime example. If you're somebody who's thinking about carrying this out, perpetrating this kind of strategy, this is a perfect example of when it makes sense to take the relationship to the next level, because it is involved. So here's our little flow chart we put together. Step one, have you maxed out your 401k? If the answer is no, go max out your regular contributions before you think about this strategy. If the answer is yes, then you have to say, okay, am I allowed to make non-Roth, remember Roth is different, after-tax contributions? If the answer is no, you don't have access to this strategy. If the answer is yes, then you have to ask, does this plan allow for in-service distributions or in-service Roth conversions? If the answer is no, all you're able to do is grow tax-deferred dollars, tax-free dollars. So no, the strategy doesn't work. If the answer is yes, if you add up all the contributions to your 401k, are you under the $61,000 limit in 2022? The answer to that is no, you can't do the strategy. The answer is yes, then you can do a mega backdoor. You can see, or if you're listening out there on iTunes or Spotify, this is hairy. This is complicated. This is financial mutant territory. So if you are someone who's thinking about doing this, trying to figure out if this makes sense, we would encourage you to reach out, think about taking the relationship to the next level to make sure that you measure twice and cut once before you put yourself in this kind of strategy.
It's so interesting. When we review plans, I know some of the big auto manufacturers and others that we've looked at and reviewed. When I see these provisions built into the plans, I'm always like, who's the financial mutant that designed this plan? Because somebody knew what they were doing. They structured this just perfectly so their employees, their executives specifically, would have access to this. So it's important for you to kind of use the tools, use the resources we're sharing with you so you understand that these tools might be built into your plan. How do you maximize them? How do you take advantage of them so you're also getting that benefit? That's why we're here creating content. As Bo shared with you, part of the abundance cycle is we'll love on you, give you tons of free advice. But when you start feeling like you need a co-pilot or you've reached a level of success that just you're the CEO now of a 7-figure financial portfolio, you might need to bring in a CFO to help you make those decisions, to ride co-pilot with you. We know that's the abundance cycle. That's why we can love on you for years, knowing that eventually you will graduate. If you're still in that journey, though, I would invite you to go to moneyguy.com/resources. We have tons of free deliverables. Go check that out. And if you want to accelerate, you've heard us talk about the financial order of operations. You've heard us talk about the net worth tool that we use, the spreadsheet that's going to let you have a dashboard. Because it's not just a net worth. It's actually a dashboard so you can track your successes. Use it as a communication tool with your loved ones. I want you to go to learn.moneyguy.com and we have you covered. Guys, thank you so much for always supporting us. We will keep creating the content that you desire and need for your wealth building journey. I'm your host, Brian Preston. Mr. Bo Hansen, Money Guy team, out.